All right, all right, all right. Here we are once again, ready to tackle the markets together. All right, up in the upper left-hand corner, we have our S&P 500. In the upper right-hand corner, we have the Dow. In the bottom right-hand corner, we have the Nasdaq. In the bottom left-hand corner, we have the Russell 2000. These are all the mini contracts in the futures market. Let's get our banner going here. So we're trading futures at the Chicago Mercantile Exchange. This is not the New York Stock Exchange. We're trading out of Chicago. When trading through Chicago, there are no pattern day trading rules. So you don't have all those restrictions. You don't have to open an account with $30,000. You can open an account with as little as $5,000 and trade long or short as often as you like, penalty free. All right. But to do this, you need to have some amazing trading software. You need to have software that hooks up to the Chicago Exchange and not the New York Exchange. So to get that, go get you some software. It's called Track and Trade. This is software I have on my screen. You can get it at trackandtrade.com. You get a free 14-day trial, live streaming data, no delay, no credit card needed. Go get your software, then come back here and join us, follow along, and you can do what we're doing here, where we're going to try and see if we can't demonstrate how easy it is to make money day trading. That was facetiousness. If you didn't realize it, I'm speaking to you, Mr. Regulator. Obviously, trading is not as easy as it looks. Hindsight's always easy. So what we're trying to do is try and teach you a little bit today about how to read the charts so you can know what's going to happen in the future, or at least, we're looking for probabilities. And anytime you're trading, that's what you're doing, is you're trying to find the probabilities in life. You're trying to find the probabilities of the market's going to do what you expect. And so we're going to look for recurring price patterns. We're going to look for mathematical models. We're going to look for, but basically we're going to use experience. So it takes a little butt in the seat time to get some experience so that you can come and do this yourself. So the very first thing you need to do is just get started. I didn't want to do these live shows, these live presentations on YouTube, but some guy just said, you know what, Lane, you just got to get started. Just got to do the first one and just get doing them. And then you start enjoying it and having fun. And okay, let's just get started. So that's what I did. I just got started. And that's the same thing in trading. At some point, if you want to do it, you just have to get started. Just have to do it. At some point you have to start. You have to start someday. So you might as well start today. Because I'm here. I'm here with you right now to help you. And I'm here to help and answer questions. I'm not going to make fun of you for asking questions. That's why I'm here. This is an education site. If you're looking for somebody to come in and dazzle you with brilliance, then you go somewhere else. Okay. We're going to come in here and we're going to talk nuts and bolts. There's no dazzling in this class. All right. This is just getting down to business, answering questions, helping people understand. And we're not going to make fun of you. We're not going to laugh at you for asking questions. I'm not going to assume that you know everything. No, this is a class for people who want to learn how to trade and want somebody to ask questions to who's been doing this for a very long time. I've been doing this for a very long time. And so I'm here to help. Just have fun. Let's have fun. Trading is fun. If you're not having fun, then you shouldn't be doing it anyway. All right. It's kind of like an adult video game. I don't mean adult in that way. I mean, it's a video game for adults. Okay. And we're going to have fun doing it. And instead of mining for fake gold, we're going to eventually mine for real gold. And that's the whole name of the game of learning how to play this game, right? The whole name of the game of life. So I wish you the best of luck in all that you do always. And I'm going to be here to root you on. And for every other YouTuber who's out there, I'm rooting you guys on too. I want to see everybody do well in these markets. It's us against them. All right. It's always us against them. And so we want to work together as an army, as a team, and we're going to try and all of us make money doing this. It's oftentimes said that 80% of traders lose money. Might be higher than that, might be lower than that. I've got statistics that can prove it's way lower than that. I've also got, statistics that can prove that it's pretty high sometimes too. But it fluctuates. Some people make a lot of money some days, some people lose a lot of money some days. But usually the reason people lose in this game, losing this day trading game is because they give up. They hit a couple of failures and then they give up. They stop trading. Um, that's the biggest failure right there, is giving up. So don't give up. Just keep trying it, working at it. You don't have to do it with real money in the beginning. Just stick in the demo account until you get some good experience behind you. Understand how these markets are working and what you're supposed to be doing, and practice. It takes some practice and some skill, and you got to hone those skills. Part of the skill is being able to move the mouse fast across the screen, being able to make decisions, being able to execute on those decisions, being able to see what's going on the screen, um, and read the charts and know what the mathematical models are. It doesn't have to be hard. If you use too many indicators or have too many decision points that's going on, that's what makes trading difficult. So we just need to keep it simple. All right, we're 27. It's getting a little excited. The market's starting to get a little excited. I want to bring up the news before we get started here. First of all, the news we had at 5 o'clock this morning. We had some news come in. We had exports. This is the good one at 6:30. Previous was 247.7 billion. The actual was 251. So we had more exports. That's good for the U.S. economy. The forecast was 250 and we had 251, and the previous was 247. So that was some bullish news to beef us up that came out at 6:30. So that should have an underlying effect. We had imports. They drag on the economy. So we had 311.5 billion, and then this time the previous is 311 and the actual is 316. So that went up a little bit, not so good. The forecast was 318 though, so it was actually lower than the forecast. So therefore, it's kind of neutral, but it's still a little bit good given the fact that we had exports that went up. So that's good. We should have this little bit of a bullish strength underneath us. We still got a minute and a half before the bell opens, but our big day is going to be at 8 o'clock a.m. 8 o'clock, we have ISM service PMI. The previous was 52.7. The consensus is 52.5. The forecast 52.4, which is all down. Okay, the PMI is down. So we'll have to wait and see. The forecast is down. We'll have to wait and see what that does at 8 o'clock and see if that doesn't move the market for us. That's supposed to move the market. So we'll just take a look at that. The market's getting a little excited right now. You can see up here the Dow up there tapping that VWAP. Here it is, tapping it on the S&P 500. It's kind of washing back and forth across it on the NASDAQ, and it's way above it on the Russell. So the reason I like to watch all four markets simultaneously is, for those of you who haven't been with us in the past, I'll just reiterate, those of you who have, suffer through my explanation here in just a minute. But these markets all have a tendency to move together. They all kind of go in waves that all move together. Now, sometimes they'll go like this. And when this is happening, where they're going in different directions, that's not good. It makes it really difficult to trade. We want them all to go in the same direction and to be conforming with each other. And then that's generally a good time to be looking to trade the markets. And what happens is you'll get two or three of them that'll take off first, and then you'll have a couple laggers that come in later. You want to trade the laggers, because if the big markets take off first, well, the laggers are going to follow. And so it gives you a little bit of a heads up at which direction the market's going to go. And then when you see the leaders start to weaken, then you know that the lagger is going to probably start to weaken too, and you can exit your trade. So it kind of gives you a little foreshadowing of what's going to happen on other markets if they all are kind of moving together. It's when they start moving in different directions that you have to be careful and kind of sit aside and wait for something. It's like, what's going on? Why is the market not working the way it's supposed to? Now, I'm not a real big fan of jumping right in on the very first bell. And this is the bell. Now, the funny thing is that this isn't really the bell of these markets. This is the stock market in New York's bell. The stock market opens now, because these are stock indexes. They're going to be affected by the opening bell of the stock market opening it up out there at 9:30 Eastern, at 7:30 my time. So what's happening is we're watching the opening bell of the New York Stock Exchange, even though we're trading in Chicago on these indexes. We're trading these indexes out of Chicago, and the Chicago market trades 23 hours a day. It only closes for an hour a day. So what happens is, look at this market. It's going crazy. That's really hard to trade. You want to jump in and risk your hard-earned money on that, go right ahead. But for me, I'm not here to tell you how to trade. I'm here to show you how I trade. And I'm an extremely conservative trader. I used to be a lot wilder and crazier in my younger days when I was a younger man. It's hard for me to say that. I still feel like I'm a young man. But when I was younger, I've been doing this for over 30 years. So um, I don't like to do this anymore. I used to jump in on the opening bell, and I used to have big swings in my trades. Used to have $8,000 winning days, and then I'd have a $6,000 losing day, and then I'd have a $10,000 winning day and a $5,000 losing day, and then I'd have a $5,000 winning day and a $10,000 losing day. That's really hard to trade that way. And so you see a lot of these guys on the internet, out on YouTube's doing this stuff, and they're like, I made $96,000 in 30 minutes. Yeah, well, bully for you. You know what? That's really hard to trade that way, because then the next day he's going to have if he took the risk to make $96,000, he's going to take a risk to lose $96,000. I've got friends who have done that. I had a friend one time who lost $80,000 in one day. He called me on the telephone. He was sitting on the toilet and throwing up in the sink at the same time. He says, I just lost $80,000 today. That's a hard day. I don't trade that big. That guy was trading multi-million-dollar accounts and had a swing of $80,000 in one day. It kind of put him on the toilet. Made it for a tough day for that guy. So I've learned myself that it's better to have a lot of consistent smaller days than to have these huge, massive swings up and down. At the end of the month, it seems that I have basically the same amount of money at the end of the month if I have a lot of small, consistent winners every day as I do as if I have all these big, massive swings. And then you can sleep a little better at night too. So nothing makes you feel worse than losing $80,000 in one day. Don't ask me how I know, because I've never done it, but I do know because I had a buddy who did it, and he called me on the phone sitting on the toilet, thrown up in the sink. I guess it's hard on you, so don't do that. I guess that's my advice. Don't do that. But you know what? He's made a lot of money in his life, so what we've got going here now is we got three markets that are all going in the same direction. We got the S&P's dropping, we got the Dow that's dropping, we got the Nasdaq that's dropping, but we got the Russell that's climbing. And this is not uncommon, because the S&P, the Dow, and the Nasdaq, these are all large cap stocks, right? The Nasdaq 100 is the 100 biggest best stocks on the Nasdaq, biggest and best. And then the Dow is the top 30, and then the S&P is the top 500, right? So you have the big markets. And then the Russell 2000 are the 2000 small cap stocks. So you oftentimes see the small caps rally when the large caps are falling. That's not uncommon. But usually we want to see all four of those kind of moving in the same direction. Where we get this ski-wampusy thing where they're going in different directions, it's called divergence, and we don't really want a lot of that. Now, here's a nice lesson for you. If we take a look at the Russell, one thing that I want you to notice is we're getting a big rally on the Russell. See that? But look at the volume. Each bar gets lower and lower and lower and lower. That's telling us that this market is starting to lose strength, and it's probably not going to go up there very much higher before it turns and starts to fall back down, unless we can get some additional volume to push that market a little bit higher. Now they're always getting a little bit more on that bar, starting to turn around, so we may get a continuation of the trend. But to see lower volume, lower volume in an uptrend, that's not good. If you want that uptrend to continue, you want to see higher and higher and higher volume while the market goes up, right? And in a downtrend, if you're going to take a short position, like right here, look at the S&P 500 dropping like a rock out of the open. We got increasing volume on a downtrend. That means that probably going to have some additional downside potential, because they're pushing that market down. More traders are jumping in. That's what volume is, right? How many traders are trading contracts? So we're getting more contracts traded in a downtrend. So that's strength to the downside. That's how you watch volume. Again, Russell, we're having lower volume. Volume is starting to wane while we got this uptrend. So if we start to see volume decrease on the downtrend on the S&P, then we would expect it to kind of roll out the bottom and start to rally once again, possibly, or go sideways. Nothing says it has to rally, but we would watch that decrease in volume We're seeing that over here on the Dow. So now the Dow fell hard out of the opening bell, and you can see volume is starting to slow down. It's gone down below the moving average. We got the moving average set to 70, or what's the moving average set to? It's set to 9. So we got a 9-period moving average on the volume. And you can see that it's starting to go down. It's fallen below that 9-period moving average. And notice what the bars are doing. The bars are starting to go sideways. There's no volume to push it down, so nowhere to go. Just goes negative. Now, if we started to see a rally, an increasing volume, increasing green volume, we'd start to expect a rally. So now, see that? Look at that. Look on the Russell. Exactly what we were expecting. We got a little bit of a bump there on the last couple of bars where we got some good volume, but now we're getting red volume, and the volume to the downside is really increasing. So the market's starting to fall as we see red volume increase. So that's how you read volume. Now, the other thing we got going here is I'm only looking at two things. Now, these charts might look a little funny to some of you, and it's because I'm using what's known as the Heikin-Ashi bars. Okay, these are candlestick bars with a mathematical model that smooths the close, all right, smooths the low. So if I turn that off, this is what other people are looking at. These are traditional or typical candlesticks. And if you notice a difference between these candlesticks and the candlesticks that I'm using, which are the Heikin-Ashi candlesticks, you can see that the Heikin-Ashi candlesticks kind of smooth out the trend. And what we don't want to see in a Heikin-Ashi trend are lots of bottoming and topping tails. So if you got charts where there's lots of topping tails and bottoming tails, that's indecision. We don't like that. Okay, we want to see markets with flat tops to the downside or flat bottoms to the upside. So here you go in the S&P. See, look how beautiful the flat tops are on those Heikin-Ashi bars. So that makes it really easy to trail your stop one price bar back behind the Heikin-Ashi bars because the bars are smooth, naturally smooth for you. It's kind of like they've got an indicator built into them. And so that's what we're looking for. We want to see these smooth trends come into these Heikin-Ashi bars, and we want to be able to maintain that trend. And so when that stops, no longer making, lower highs and lower lows, then we want to either look for a decision point for taking the continuation of the trend, the reflection down, or maybe a rebound. Now, oftentimes what we see on the morning bells, we'll see the market will flush down. They call it sweeping out the stops. All right. So the market sweeps down, sweeps out all the stops to the low side, turns around, goes up, sweeps out all the stops to the upper side, and then it kind of decides what it wants to do. Then it starts a new trend. So it'll flush down, it'll flush up. It goes kind of jumps all over the place, which is what makes it difficult to trade. You don't know that a market's going to, take off and drop like that, or whether it's going to rally like this in the first thing in the morning. I mean, you never know. But the whole idea is that you're trying to get an idea of what's going to happen here by watching volume. And we're just sitting this out. There's another 6-7 hours of trading. There's no reason you have to jump right in on this very first move. We want to wait until we get a good solid signal. We know what we're going to do here. I like to trade the ABCD pattern. All right. The ABCD pattern. So I like to see the market move, have a little bit of a retracement, and then drop once again if it's going to fall. Or in this case, we can say the Russell is rallied, has the little pullback, it starts to rally once again. We would expect, this is called a Fibonacci projection. It's an ABC pattern. So we're going to go off this low here, and you get A, B, and then you get the pullback to C, and then we expect it to make basically the same move from A to B as we expect from C to D, which would be to 100%. Now this got kind of an ugly bar in there. We've got what I call a clearing bar. See this clearing bar right here on the Russell? Let's bring it full screen so you can see it. And I'll make it a little larger for you. But see that bar right there with a big topping tail and a big bottoming tail? That went and cleared out all the stops to the upside, and it cleared out all the stops to the downside, cleared out all the limits to the upside, cleared out all the limits to the downside, and now the market becomes neutral. Once you get a big clearing bar like that and it clears everybody's orders out, it takes out all of the liquidity, top and bottom, wipes everybody out. Nobody made, you never know who made money in that, but that's the whole idea, is it wipes out all those orders. And then the next bar is oftentimes a signal of the direction the market will go, because if it wipes everybody out and everybody has to start over fresh, who's got the strength? Well, in this case, it was the bulls. The bulls are stronger than the bears, so we got a flat bottom green bar, which indicates that we cleared out all the stops and limits, and now we're going to go bullish once again. So that's kind of the idea of a clearing bar. So you want to watch for clearing bars. because they are going to kind of set the direction for the next trend. And you see those really strong in the in particular in the Heikin-Ashi bars. You don't, you get clearing bars in the other normal style too, but they're easier to see in Heikin-Ashi. See, so this is your clearing bars right in here, because in this case it was two bars that made up that clearing bar. If we go to the Heikin-Ashi bars, that's consolidated into one bar. You see one bar clears out both tops and lows, and then we get a flat bottom green bar. That's a bullish signal indicating that we're going to probably get a rally out of this market, and we could look for it to rally back up and maybe test that blue line, that average, the VWAP, volume weighted average price. So that would be kind of the target on the rebound. So markets generally have a tendency to dive down in the morning and then turn around and rally back up and then turn around and fall again, or at that point they start the trend. So we like to establish the high and the low of the first 10 to 15 minutes, 5 to 10 minutes. So we're going to establish a line here. I'm just going to draw a trend line across the top of those price bar highs, and then I'm going to draw a trend line across the price bar lows, and those become kind of a bracket for the day. And when the market gets back into that bracket, it becomes a neutral zone, and we're not sure which way we want to go. We don't know whether we're bullish or bearish at that point. Now you can see down here on the Russell, we had that clearing bar cleared out. We got a flat bottom, and it's been a flat bottom ever since. And so we've gone from the A to the B, pulled back to C, and then it started to rally back up, and now it's up to here to 100%. 100% from C to 100% is the same distance the market rallied from A to B. We had the little pullback in there, so that's your A, B, C, D pattern. And I like to trade those C to D patterns. Now, this one wasn't very clean, so I didn't feel comfortable doing it. And of course, it's in the first 5 or 10 minutes of the market, and I'm not really interested in trading this wild and crazy market as it sits here and tries to figure out whether it wants to be bullish or bearish. So we're going to give this a little bit more time and just kind of watch and wait. And I want to see the market establish a decent trend, and then I want to see a hesitation in that trend, what we call flagging, or this little ABC pattern, and then we want to see a continuation of the trend. Sometimes you'll just get a roll over. You'll get a straight up, straight down, straight up, straight down. Those are kind of hard to trade because the market changes directions, and then you don't know which direction it's going to go, and it just keeps on going in that direction, then turns around and goes the other direction. They look easy in hindsight, but in reality, they're a little bit more difficult to trade because you don't know that it's going to turn and make that V correction. V recoveries are difficult to trade. You need some sort of a little hesitation or a little ABC in the trend to give you an entry point. And so where this market turns right around, so on the S&P, see how it's turned right around, it just went right straight back up. Now, of course, we're using the ATR, and the ATR is telling us when the market's changing from bullish to bearish across the average true range. And so these are oftentimes good signal points. You can see we got the clearing bar and the flat bottom, and we could have taken a long position there in anticipation of the rise to the blue VWAP, like we said. But I would like to see a nice little pullback, a couple little red bars in here. And I want small bars because you put your stop back behind areas of support, because the definition of an uptrend is higher highs and higher lows. The definition of a downtrend is lower highs and lower lows. Okay. So if you're going to trail your stop, you want to have it behind the low of the low, because if it changes that and it's no longer making higher lows, well, you're no longer in an uptrend. So there's really no reason to stay in the market. And that's where Heikin-Ashi really kind of comes in and helps you with that, because it's got that built-in trailing stop buffer on those bars. And it just kind of tells you, hey, the market's no longer bullish, or hey, the market's no longer bearish. And so you can use those as a trailing stop location. And the software that you use is really super important for that. You really want to trade, if you're going to trade, you want to have a high performance trading platform. You don't want to try and trade like this with just some free internet charts or something, because they don't have the ability to trade for you and help you make those trades. If all you're doing is hitting buy market and sell market buttons, or if all you're doing is, you know, banging around in an order entry tab, you're not going to be able to trade these markets with the precision that you need. You need to have a high performance trading platform, whether it's this one or another one. Just don't go use and think that you're going to find great success. You're going to be part of the 80% losers if you're out there using cheap, free online internet charts, because there's a big difference between a trading platform and charts. If all you want to do is you want to buy a stock every 6 months or every 3 months or every 3 weeks, you want to buy a stock, you can use those free crappy platforms on the internet. But if you want to be a performance trader, you got to have a trading platform. So there's a big difference between the two. Speaking of that, why don't you run out and go get your track and trade software? That's what I'm using here. Get a free 14-day trial at trackandtrade.com. And then you can come along and join us and you can do this too. All right. And while I'm thinking about it, why don't you guys go ahead and ring the bell, subscribe and ring the bell so that you know when I'm going to do these live shows. I don't do them every single day. I try to do as many as I can a week in the morning, come and spend the morning time with you and talk a little bit about what we're looking at on the morning bell. But, subscribe to my channel here and ring the bell so that you get notified when I'm going to do a live presentation. Now I try to put my live notices out there the night before. If I'm going to have a live morning class, then I try to put that out the evening before. So if you ring that little bell on the on the on the YouTube, then that will notify you that I'm going to do a live class. So it would be nice if you guys wanted to comment. We got some comments in here. Trading Research says good morning, and B. Taylor says good morning. It's great to see you guys in the room. So we've got B. Taylor and we've got Trading Research. Thanks for coming and joining us. It's great to have you. And let's come back down here. Let's run around here a little bit. We just dropped Pit News Magazine while we're watching these markets jump up and down and run around. Now, what we're looking for here, I want to see the market kind of make a decisive trend. Right now, it's just kind of chopping back and forth through this little wavy, snaky pattern. We need an opportunity. Now we're seeing on the Dow and on the S&P, this is a little pullback that we could trade. Okay, if it doesn't break the average true range and it turns and starts to rally once again, then we can look for a reflection or an ABC pattern, right? But if it breaks the average true range and closes below the average true range, then we can't go long. We need it to stay above the average true range and then turn and start making higher highs once again. Then we can take that little ABCD pattern. But it's coming down, it's pulling back a little bit too far, rallied a little bit too far to be a downtrend. We're just kind of hanging out in that neutral zone. Remember, we drew the neutral zone in here. So we just have to kind of wait and see. I'm watching the S&P. It looks the best right now. They're all four moving in the same direction, and that's what we want. We want to see all four markets moving in the same direction. And then we want to see a leader. We want to see one of them take off and go before the others, and then we'll trade the lagger. We'll trade the follower. And I've got my QOCOs. I got my auto trailing my order set up over here. And I'll show you how we do that. I got these programmed in here. You can see I've got a a whole bunch of pre-programmed auto systems in here. So that my software again is a trading platform. It's not just charts. And so charting isn't a lot of good unless you have the ability to trade on them, right? You got to trade. So I just dropped an order onto the S&P. I'm going to watch the other markets. I got to keep an eye on them, but the S&P is hanging above the average true range. It hasn't broke the average true range. And so it's starting to look like it wants to turn and rally and give me that reflection or that ABC pattern like we saw down here on the Russell. So if we come in here and look, you'll notice that the software is now trading for me. I dropped that order in, and Track and Trade is actually moving that order based on how I programmed that button to do what it's doing. So I'm looking for now a rally. I want to see it rally up and break a new high. We're in a downtrend, so I want to see it break a new high, start looking for it to rally once again. And we'll look for that reflection or that ABC pattern. It's got to stay above the ATR though. If it goes down and closes below the ATR, I'll throw it out and just go again. Just wait for another opportunity. Okay, look, the Russell just broke. It's kind of the leader. We got the NASDAQ. It's going green. It just broke the previous high. The Dow has not, and neither has this S&P. But this gives me some confidence. I Seeing the NASDAQ and the Russell start to go green, that we might get a green bar right here on the S&P without. There we go. Okay, we're long the market. Now what do? Well, we need that market to rally and get us into profitable state. I'm only in with one contract right now, just going in small. No reason to take a big risk. So now we're getting a higher high. Notice that the software did that for me. Once I placed my order, it trailed down behind those red bars until the market turned and broke that first green bar to make a new high. That's what we're looking for. We're getting the same thing on the Dow. That's good. We're getting the same thing on the Russell. We're getting a long bar on the NASDAQ. The NASDAQ is pulling away, and it's pulling these other markets up with it. That's good because the NASDAQ is the biggest market and has the biggest stocks in it. NASDAQ 100 is mostly tech stocks. So if that thing blasts off, these others should follow, and that's a good sign for us. Now, if the Russell doesn't blast off, that's not a good sign, but it's not going to hurt us too bad because remember, those are small caps. So the big caps are now starting to run and the small caps are starting to die. And we saw that a little earlier where the small caps were running and the large caps were shrinking. Now we need to get a stop in here. And I'm going to do that with a quantity 1. I'm not going to reverse my position at this point. I'm just going to drop that in there and it's going to trail up. And actually, I'm going to come in and tell it just to trail to break even. I just want it to trail up one price bar back. And I'm just going to have it trail. Well, actually, I can't do that unless it's an OCO. So I'm going to come in here and I'm going to kill this order. And I'm going to add an OCO order. So that's one cancels other. And I'm going to tell this one I want it to trail. And I'm just going to trail up at this point one price bar back. There's a number of ways we can trail it. So I'm going to trail it 1.1 price bar back. So 1.1, 1.1 means one price bar, 0.1 means one minimum move. So just accommodating for that spread. And I'm just going to trade as long as we're getting a flat bottom Heikin-Ashi bar, right? I want to stay behind the market on a flat bottom Heikin-Ashi bar. I don't want it to come down and break the bottom of that Heikin-Ashi bar. And we're just going to trail this to break even one price bar back, and it's starting to weaken right here. It's bouncing off of that VWAP. So we need it to break through that VWAP and continue higher. Otherwise, we're just going to get out. We're going to get knocked out. Once it gets to break even one price bar back, then I'm going to switch it over and just put it on the ATR on those little yellow dots. And I'll just let it go until either one, we hit our daily goal, because our daily goal in this class is $500. So if we can make 500 bucks a day, that's a pretty good income. And again, it's not swinging for the fence. It's just trying to make base hits. And we're just going to make a little base hit every day, make 500 bucks a day. And that's a pretty good income. So that's our goal. Doesn't mean we're going to hit our goal every day. And sometimes we can go way past our goal. If we hit our $500 goal and then we still want to continue to trade, then I like to cut that goal in half and say, okay, now we're going to risk $250 of that to make another $250. And so if I lose $250, well, I've lost 50% of the value of my trade. Okay, so at this point, I'm going to come in here and it actually, I forgot to turn on trail until break even. So I jumped a little bit ahead of break even, which is okay. I'll just leave it right here, but I'm going to change this now over to the ATR. So now it's going to trail on the ATR. So it's just going to sit here and wait for that ATR to catch up to it. It's not going to jump back to the ATR because it never pulls the stop back. So whatever the stop's at, I meant to just bring it to break even, and I didn't click the little box to go to break even. So it's actually one bar back from where it's currently trading. We may get stopped out right here if it doesn't break higher. It needs to break above that VWAP, and we got stopped out. 25 bucks. But at least we tried, right? Better to have tried and failed than to have not tried at all. So let's see. Let's take that off the screen, B. Taylor. And we'll sit and wait for another opportunity. That was a weak market. Didn't give us that bump that we need. We're still stuck in that channel. So we need to have something happen here for us. Look how nasty the NASDAQ looks. It's just kind of chopping all over the place. But we just dropped our Pit News magazine over at pitnews.com. It's an awesome magazine. It comes with audio, so every article has an audio, and some of them even have video. And so you can listen to the magazine, you can watch the magazine, and you can read the magazine. It's a true multimedia magazine, and you can get it if you use my code LANDLIVE-$1. If you use that code, you can get an entire year for $1. Okay, this is another opportunity. See this thing here on the S&P? If it doesn't break below the, if it doesn't break below the, we're going to drop another trailing stop in there. If it doesn't break below the ATR and it goes up and breaks another green bar to make a new, a first green bar to make a new high, we can try and go long again. But the market's really weak right now. It's quiet. We've got, well, you know what? I don't want to take a position right now because we got another government report coming out here in 3 minutes. The ISM services report. If you click on it, you can open it up and it tells you a little bit more about what the ISM report is. The ISM services PMI fell to 52.7 July 2023 from a 4-month high of 53.9 in June compared to forecasts of 53. The reading points to slow down in services growth due to smaller increases for business activity and production. New orders 55 versus 55.5, employment 50.7 versus 53.1, and investors 50.4, 55.9, while suppliers delivery times were faster. At the same time, price pressures increased while backlogs of orders rebounded. Also, the majority of respondents were cautiously optimistic about business conditions in the overall economy. So if we come and look, this is the past. So we're waiting for this thing to come out. So the United States ISM Services PMI, the non-manufacturing ISM report on business, is based on data compiled from purchasing and supplying purchasing executives nationwide. So surveys responded reflect the change, if any, in current months compared to previous months. So this is your purchasing manager index. All right, that's what PMI stands for. And it's whether they're buying stuff. That's what it's all about. Are you buying stuff or not? And so at 8 o'clock, we find out if they're buying more stuff or not. And that's going to happen here in 1 minute. Let's get this off the screen and watch the markets. So good thing we didn't take a long position off of this right now because it's being real weak. It gave us a clearing bar. It might rally. Might be a good place. We could put our stop on that yellow dot and watch this market over here on the S&P rally. But let's watch all the markets right now as we come into the PMI. Supposed to move the market. What do we got? 58 and 23 seconds. We got 23 seconds to the report. Let's put the report up here. I don't want to cover up too much of the chart. I'll just bring it up when they fill in the numbers. I'd rather watch the chart than the numbers. See that S&P breaking down? We're waiting for these numbers to come out. Where are they? Come on, guys, give us the numbers. There it goes. They're coming in. You'll know what the numbers are. You know what? All you need to know is that numbers are coming out. You don't need to read whether they're positive or negative because the chart's going to tell you. And what happens oftentimes, you'll get this news and they'll go all over the place because sometimes, guys think it's positive news and some guys think it's negative news, and however they read it, you say, well, if it's positive news, isn't it obvious? Well, sometimes positive news isn't as positive as some people thought it was going to be. So it ends up being, even though it's positive news, it's negative. So you have to take that into consideration. So the numbers haven't hit yet and we've passed our time. Oh no, we haven't either. 7:59. So we got, here it goes right here. There we go. There's the numbers. And the numbers come in. Previous was 52.7. Actual is 54.5. So apparently the market thought that this was bad news. All right. The previous was 52. The current is 54. And the forecast was 52. These are actually bigger numbers. So I'll show you. So the actual is 54.5. The previous was 52.7. The consensus was 52.5. And the forecast was 52.4. And it hit 54.5. So the ServiceMan PMI says, hey, we're buying shit. Excuse me, we're buying stuff. We're buying lots of stuff. That's usually a good sign. But the market didn't see it that way. Interesting, right? We've got Fed Logan speaking this afternoon at 1 o'clock too, so that always kind of messes the market up a little bit when you got a Fed speaking. Although this one is just Fed Logan, so it's not a red, so it's not that big of a deal. It shouldn't actually move the market that much. So the market actually sees this as negative. So we're getting a bearish drop on this. So let's wait and see. Leave a comment down in the, it's nice to have you guys in the private chat, and I appreciate your private chat. But I would also like to see you leave a comment down in the comment section. This is my channel's not new. I've had my channel around for years, since 2018. I've been posting, the long form videos on here and educational videos. We started Trade Mentors a long time ago. So it would be nice to have some comments in the comment section, because that always helps the algorithm. The algorithm will then look at this live session and say, hey, people were engaged in the live session, and that'll bring more people in, and that'll be nice. We'll have more people in here with us. It's always nice to have more people to be in here. If you guys have any questions, feel free to ask them. It's like, well, Lan, why aren't you trading? Why aren't you in? You should be in and out and in and out and in and out. No, 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 that's over trading. We don't need to do that. Just be careful. Be careful. Now, here was two places we could have got in. And then, yeah, you look back in a little bit of hindsight and say, oh, I feel bad I didn't take those positions. So there's a nice little flag, and there's another nice little flag right there. And those were entry points in here. But we were coming into this news report. We didn't know whether it was going to be bullish or bearish. And it's bearish. And so we're going to watch this market and see if we can't get an opportunity. But we want the market to move first. That's my strategy. I don't want to try and catch the first run. I want to catch the second run. I want to catch the C to D, not the A to B. So this right now is a new A to B, because the market was kind of going sideways, waiting for that government report to come out, right? And then it's fallen real hard. Now we're going to watch and see, and the ATR will kind of help us know whether it's going to be bullish or bearish. It's currently bearish right now. We could be crazy and just jump in every time we get an arrow off of the ATR, get a reversal. You could do that. I'm not telling you how to trade. I'm just telling you how I trade. And I'm a real conservative trader. I want to wait and make sure that I don't take stupid moves. If I don't know what to do, I don't do anything. If I'm not sure about what I want to do and I don't get the perfect setup, then I don't do anything. I wait and see. We got 6 more hours, 7 more hours of trading. I know guys that'll go and work 8-hour days to make $500 or less. And we've taken one trade in the first 30 minutes of the day. That's okay. The biggest problem most traders have is they overtrade. They trade way too often. You come and watch me and you're like, oh, that guy's so boring, never trades, just watches the markets. Well, I'm waiting for a good setup. I want a good reason to trade in. I had the government report, so I was a little nervous about what the market was going to do. I didn't know what that government report was going to come out and make the market do. I didn't know if it was going to rally or fall, and I didn't want to be in a position during a government report. Do you? I hope not. Don't want to be in a position during a government report. And if you're not watching those government reports and you don't know when those government reports are coming through, you can get in trouble. So you got to pay very close attention to what's going on in the government reports every day. Then we'll have plenty of opportunities here. We're not freaking out. Yesterday, I think we went away with a small $25, did the same thing. I was on here for an hour with you guys here watching the morning bell, and I think we took a couple trades, ended up with $25, kind of like this. And then, of course, I kept trading afterwards, and ended up yesterday was a good day, over $1,000. Of course, it wasn't on video, and it wasn't during the morning session where I'm here with you guys. It was on my own trading when I was after I'd closed the class. But sometimes. And yesterday I made the comment, we had kind of a really tough morning. It was just bouncing all over the place, and it wasn't really doing well for us. So we ended up taking a couple of trades and didn't really make a whole lot of money. And I said, well, watch those top of hours. Watch 9 o'clock, watch 10 o'clock, because the market has a tendency to, if it's drifting a little bit quiet during the 1 hour, the next hour, it oftentimes will pick up. So watch for those top of hours. And I surmise, I don't know why it seems that way, but it seems like at the top of the hour, the markets will kind of start afresh and new, and you'll get new trends coming out of those top of hours. So it's 8 o'clock right now. We're looking for something to happen here. And then 9 o'clock, we'll wait for something else to happen. And if nothing really happens at 9 o'clock, we'll watch for 10 o'clock. The afternoon session, while the New York and Chicago guys are at lunch, aren't generally too exciting. But I have a sheet of paper here where I've done a whole bunch of back testing, and I'll flash this up to you. I keep this on my desk. You can kind of take a look at that and see what that says, maybe. But best times to trade and what times not to trade. And I've done a tremendous amount of back testing. Between 9 a.m. and 10:30 a.m., we generally get some good trends, and I've had a lot of good luck during those time frames. 11:50 a.m. to 12:55, usually pretty good time to trade, believe it or not. This is my time, of course. I'm in Mountain, so I'm at 2 hours behind the Eastern time. And then I got the don't trade time frames in here, and I've got the do trade time frames in here. So 7:30 to 7:36, don't trade. I've got that in there. 7:42 to 7:48. Don't trade. 8 o'clock to 8:20, don't trade. I've got a bunch of little times in here where I've done a lot of historical backtesting where these are times that failed, the markets didn't move. Look at the Dow's starting to take off. So now the Dow's starting to give us some movement to the upside. The NASDAQ starting to fall. So the NASDAQ is probably bottoming out, and we're going to probably see the NASDAQ start to rally and the S&P starting to rally. So we want to see a continuation of the trend. So I've got a do trade time frame. It says 8:20 start to trade, 8:07 start to trade. Look, what time is it? It's a little bit after 8:07. Look at that, 8:07 start to trade. Look at the markets, 8:07 they started to move, started to trade. 9:07 to 9:36. We got some different times in here that have high probability in the past. Past performance not necessarily indicative of future results, but it's the best information we've got. So we can look off of that. So we're getting a reversal here. I want to see it close above the ATR, and I want to see 4 green bars, and I want to see a pullback bar, and then I want to see another nice big run and a retracement and a rally. Remember, the government report news, in my opinion, was bullish. It was positive. So we flushed out to the bottom, and now I think we'll start to rally. But even still, these look like nice little trends, but they're not. The market's still just kind of wandering sideways. So we've got the high point here, we got the low point here of the morning session, of the morning bell, right? And it came and went right back to the dead center, came down, broke it just to prove that it could, didn't hold below it. Now it's starting to rally back up, and it's going to test this previous high up in here. So I was looking for a little pullback. We got 1, 2, 3. I usually like to see 4 green bars. 4 green bars, and then and I want them to be a little bit bigger than that. These are not very good green bars down here. I want to see them a little bit larger than that. But 4 green bars, 5 green bars, and then two little red bars, and then the first green candle to make a new high off of that one. Boom, I want to see it go to the moon. That's what I'm waiting for. So if you look down at the Russell, it went up and tried to break the average true range, but failed. The S&P hasn't, so this actually could be a reflection to the downside, right? So if this market doesn't go up and break that ATR to the upside, we could take a cautious position to the downside and look for a reflection down the lower side. So I've dropped my order in there. If it breaks, we'll look for the possibility here on the S&P to go short and get that reflection to the downside. So if we got A to B, C, and then if it continues to fall, we'd expect it to come all the way down to 100%. And that would be a nice run for us. Now, if it doesn't, we just get stopped out, take a small loss. We'll try again on the next one. So it did. It broke down. Now we just need it to continue to fall. So the Dow is starting to fall. That looks positive for us. The Russell is starting to fall. That looks positive. The NASDAQ is not. The NASDAQ needs to fall, and it's not. So we're in a bad zone. This came back, stopped us out. And if it breaks and goes higher, we could reverse our position I want to be trading this market. I might drop a stop in there and get stopped out at the average true range, but it looks like it's starting to fall back in our favor again. I'm just going to drop this. I'm going to drop that order in there. Now it's being stupid. It needs to move. We need some action here, guys. This is our signal to the downside. This is the first red bar after the nice green pullback. That's a little flag formation. And now we need that next leg down. And if it doesn't decisively move in our favor, usually it's not going to be a good trade. We just get out, take a small loss, wait for the next opportunity. But we need it to fall here. And it's falling over here on the NASDAQ. That's a good sign, but we're getting a rally on the Dow. So that's not good. We're getting divergence. They're going in different directions. The Russell's starting to rally. This is not good news. We don't want to see this indecision. We want to see a very decisive move. If it's decisive like that, generally often I'll just get out. But if it breaks and starts to go higher, we might want to take and go a long position, get the reversal. But it's not the greatest place for a reversal. Now it's starting to fall a little bit. Look at the NASDAQ. The NASDAQ has flat top Heikin-Ashi bars, whereas the S&P, of course, the one we're trading, Murphy's Law, we're not getting that flat top Heikin-Ashi bar. We got a little tiny indecision indecision bar. It wasn't really a clearing bar because it didn't clear the highs and it didn't clear the lows. It was just an indecision bar. The NASDAQ's still falling, giving us some, we're getting a red bar over here on the Dow. This is the most, this is the most difficult stage of your trade, when you're just right here, where you're just trying to get in and try to get your stop move to break even. You just want to see that market move decisively in your favor. And when it doesn't do that, it's a little nerve-wracking. You want it to go. You want it to go. You don't want to get into a bad situation where the market starts to just go sideways and pop back and forth. You need a decisive move once you get in. The single contract, we're only in with a single contract. And I'm going to go ahead and I'm going to kill this reversal order. And I'm going to add an OCO at this point. And I'm just going to trail. I'm not going to trail. I'm going to trail the ATR because I'm not going to trail a one bar back because the bars are being so stupid. This is disappointing. The only thing that's keeping me having hope here is that the other markets are falling. So I'm watching the NASDAQ fall. Let's go ahead and put this stop in. Let's set our target. Our target for the day, we're up 25 bucks, so that's nothing. So we'll put $500 in here. We could put a little bit, 475 if we wanted to be exact. But so that's our long-term goal. Now we may not hit the 475 on this one, but we got to get our stop to come in and maybe get stopped out with less than 475. Then we have to trade again. But if we can get it to go down and take that 475, we only have one contract, and it's being stupid. Technically speaking, at this point, I should just get out. We're barely in the money and the market's being stupid. It doesn't look like it wants to fall. I'm going to hang on just a minute longer to see if we can't get it to go down, risk this market failing on us, in hopes that we get a little bit of. The only thing that's given me some positive momentum here is the fact that the NASDAQ is still falling, and it's starting to rebound right now. So I don't like this trade. I'm just going to kill it. It might be the wrong thing to do, but if I go 3 price bars and it doesn't decisively move in my favor, the market's weak. There's no, look at the volume, it's all dying. Now it could turn and fall right now and I feel bad and have FOMO, but there's more often than not I've had it when this fails like this and does this little weak dance where it comes back up and stops me out, and I end up taking a big loss, and then I have to recover my loss. I'd rather scratch out and wait for another better opportunity. Market's just dead. So we're sitting here wait for another opportunity. Now, I could have stayed in and it could fall, but because it's being stupid, I don't want to take that chance. I want the market to decisively move in my favor when I get in. And if it doesn't, and it sits there and does this stupid little sideways dance, just kill it. You don't want to sit and take a big loss. The worst thing about trading is trying to recover from losses. Market goes red on you and you get stopped out 2 or 3 times trying to get into a trade, and now you're down $200-300. That's no fun. So it's better for me, in my opinion. Again, I'm not telling you how to trade, I'm just telling you how I trade. I'd rather just take a scratch trade, get out, take a small loss or something, than to risk the fact that the market's not going to drop and go decisively in my favor. Okay, so now we're getting a rebound. See, good thing we didn't stick in that thing. We'd have got stopped out with a bigger loss. We'd just be getting out of the market right now, and that would have been down. We'd have been down, if I wouldn't have cut that when it wasn't moving, we'd have been down $125 right now. Well, we had 25, so we'd been down $100 right now instead of up 12. So it wasn't decisively moving in my favor, so I just killed it. And now you're like, whoa, go long now, go long. We will. Let's give it a chance to prove that that's what it wants to do. Because this might just be another little pullback before it drops once again, right? Could give us this little pullback and then drop once again. So where the market's being stupid and sideways, I'm not real anxious to put an order in there. But if I were to put an order in, I'd want to go this direction right now because this is still bearish. See, we're in a bearish downtrend. Now we're going to get a switch right now because it's going to close above the ATR. The average true range of the market is just set to 1. I've just got it set to 1. And on these Heikin-Ashi bars, that's a good setting. And so now we're going to make a reversal and start to go bullish. But at this point, I don't know that that's going to go bullish. It might still go down. So I have my stop to take a short position, right? It's at that point right there where that arrow comes in and says, we're no longer in a bullish trend land. We're now a bearish trend land. We're now bullish. Okay, so I'm going to kill my short position. Now we're in a bull trend, back into a bullish trend. Now, the thing is, there's one up for every down when it comes to trading. There's one up for every down. The one thing we don't know is how long that up's going to be, and we don't know how long that down's going to be. Okay, but if there's one up for every down, it makes it really easy to draw your trend lines in here. You just draw your trend lines, say, well, there's one down, and now we're going to the next up. How high is it going to go before it turns and starts to come down once again? So there's one up for every down. We just don't know how long each up and down are going to be, and that's the chance you take when you trade. So what I want to do is I'm getting the first leg of the up. Okay, so we're in a new uptrend. So what I'm going to do is I'm going to wait for this market to go up, and then we're going to get the little pullback. That's what I want to see. We call it a flag. All right. So the market is flagging. So I want to get 4 or 5 bars up. Generally we get 4 or 5 higher highs, 5 higher lows, and then we'll get a little pullback, which will give me the opportunity to put my order in there and let track and trade that for me, because I'm not as good at it as track and trade is. It's a lot more proficient at trading than I am. I just want to tell it when to do it. So then I'm going to put that order in there. The market's going to pull back a little bit, and then the first green candle, after I get a couple of little red candles, boom, I want to take that position and watch that market continue higher. So we'll see if that happens. If it doesn't happen, we won't do it. We'll wait till 9 o'clock, wait till 10 o'clock, wait till the top of the hour. All right, let's see. Steve Scott. Hey, great to see you here, Steve. Steve Scott. Glad to see you here. What stocks are we trading? B. Taylor asks, what stocks are we trading? These are the indexes. So we are actually trading. I'll put a little banner up here that kind of explains it a little bit. We're trading in the futures market, and we're trading through Chicago. We're not trading through New York, although these are stock indexes that are traded on the New York Stock Exchange. We're actually trading them in Chicago. Okay, so they are indexes. So if you see up in the upper top left-hand corner, you see this is the S&P 500. So that's my S&P. Up in the right-hand corner, this in here is the Dow 30. Bottom right corner, this is the NASDAQ. Top our bottom left corner, there's the Russell 2000. So these are just the indexes, but we're trading them in the futures market. Okay, we're not trading them over in the stock market. So the futures market, a little bit more efficient over here. We don't have pattern day trading rules. We don't have to worry about that type of stuff. We don't have to worry about, okay, hold on a second. I'll finish my talk here. I'm showing you what's going on the S&P right now. And also over here on the NASDAQ. We're getting another drop right here. So we got a clearing bar. See that bar right there? I'll make this bigger so you can see it a little bit better. Although when we do that, we can't see the other markets. But I'm going to show you right here what we're looking at. This is called a clearing bar. See, we got a reversal, which tells us the market wants to change from bearish to bullish. And so we crossed over that average true range, which is just set to an average true range of 1. And then this is a clearing bar. See how that bar broke all the highs and broke all the lows. So what it did is it went out and went wham, and it slammed out, and it cleared out all the stops and limits above the market, cleared out all the stops and limits below the market. So generally what happens when you get a clearing bar is the next bar indicates the market trend. So this is indicating that we should get a downtrend at this point because we had a clearing bar. And if a clearing bar takes out all the traders, then everybody has to get back into the market. And which ones are going to get back in? The ones that are going to drive the trend. So they're going to drive the trend. Which ones more? Well, most of them are taking a short position at this point once they all got cleared out. So this is indicating that the trend should be down. Okay. So whenever you see this pattern right here, this clearing bar followed by a flat top or a flat bottom, that's generally the direction the market's going to go. So we had a rally to the upside, just a 4-bar rally, and then we got a clearing bar, which is reversing the trend in this case, and the market's starting to come back down now. So they cleared out all the orders. Everybody has to jump back in to get into the market. Which direction are they jumping in? They're jumping in short. So now they're pushing the market back down. All right. So keep that in mind when you're looking at these Heikin-Ashi bars and we're looking at the trend. Okay, so now we got a reversal. So now we're back into a bearish market again. So we're getting through a lot of chop right here. This is not a trending market. It's a choppy market. We tried to take a short position off of this trend right here. So we tried to take a short position off of that little pullback right there, and it failed on us, turned and went long. And I don't want to take the first breakout. I call that the A1, right? Remember, we don't want to take the A1s. So the A1s, we want to take the A2s. We want to take the second A drive. So now this one gave us a clearing bar. It's going red. And so it failed to the bull side and it's going down now. But that would be a new A1 to the downside. Now we don't want to take the first A1 to the downside either, generally. Sometimes we will. We're going to want to wait now for this market to go down, and we got lots of areas of support in here. So this is the support areas, and it's going to try and break through the area of support. And if it can break through that area of support, it'll probably go down, and then it'll probably pull back, have a couple little green bars, and that's what we're going to look for. So we're going to come in here, see if we can't get a couple little green bars. If we can get a couple little green bars, then we can take another short position and look for that reflection is what I call it, the A, B, C, D. And we want to ride from C to D. That's where we make our money. So until we get that set up, we just sit and wait. Because all we're getting now is just a bunch of choppy sideways markets. We're not getting anything. We took a couple of test runs and got nothing. And I want to get in on tiny bars. I don't want to get in on great big bars because then you put your stop back a long ways. So you're like, oh, Lan, you should have taken that arrow. Maybe, those are not bad places to get into markets. Those crossing of the ATRs, as you can see in the history, those are generally good locations to be getting in. But I want to see it get in and then pull back a little bit and then take off again. That's what I like. So sometimes you miss it. Sometimes the market goes and then it just, bam, it goes forever and it never gives you that little flag or that little pullback. It never comes back and gives you the opportunity or the hesitation in the trend to get into the market. And you just have to sit, and then you have FOMO. You feel bad. You sit there and watch it go without you. And you're like, there was my $500, but it never gave me an opportunity to get into the market. So you just have to sit and watch it go without you. Okay, while we were looking at that market, some of these others are doing all right. So we're getting the chop is coming in here. So we got a rally, pullback. Now we're getting another clearing bar. Went up, broke the previous high, take out all those trailing stops, went down, made a low, but it came back to hit those trailing stops right there. So if we'd have been trailing one price bar back, we'd have just got stopped out on taking that first arrow. So that's why it's difficult sometimes to take the arrows, because the arrows will get you in, but then sometimes the market pops right back with a bar like that and stops out all the trailing stops for the guys who got in on the arrow. Okay, look at the NASDAQ. So it's rallied, pulling back. This is just chop right now. I'm not real excited about it. Let's see. Let's get rid of all these drawings. I just want a stronger trending market, that's all. So if we'd have got in on that arrow, now remember, the arrow points at the bar that created the mathematical model that gave you the arrow. So you can't, it gets in on it points at the bar and you can't get in on it because it has to close to give you that arrow. And that's the math from that point back to the previous arrow. So you can't get in on the open of this bar, you get in on the close, which would be the open of the next bar. So you'd be in this case, down on the open of this bar. Of course, it's a Heikin-Ashi bar, so turn that off and you can see a little bit better. You'd have been in on this arrow right down in here somewhere. Okay. And this market's okay. So the Russell, let's go back to our Heikin-Ashi bars. The Russell is the one that's giving us the pullback, that the opportunity to take the short position. See that? Everything else is still dropping. And we got the little pullback here on the Russell for the down reflection. Now we just don't want it to break the yellow arrows and go up, and we can put an order in here to take a short position. If it breaks, we want the first red candle to make a new low. So we want that candle to break a new low here, and we'll take a short position in anticipation of a continuation of the downtrend. Really, I'm not very happy about this. It's not very strong over here. I mean, the S&P looks good, you know, but it's not giving us a pullback and an opportunity to get in. It's just bar, 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 bar. Okay, so we're in on the Russell. Let's see if we get a continuation of the downtrend. So we got our little flag. This is just called a flag, little pennant formation as it come in here. All right, so we're taking the break out of the bottom of that pennant formation, and we want to see it continue. We want to see this A, B, C, A, B, C, and we want to see it continue down. And the biggest part is it's got to break right now. It's got to break that previous low, and it's got to hold below that previous low. Now we can come in here and we can add our OCO order and give this stop some instructions and tell it, okay, I want you to trail. At this point, we're just going to go price bars back 1.1 until break even. That's the setup. That's the rule. Once it gets to break even, we're going to stop trailing, and we're going to put out there that want to trail on the yellow lights at that point, and we'll just wait for it to go down and either hit our target, which in this case we're up a whopping $12. So we're going to put this down here, and we're on a smaller market. This is a smaller market, so we probably won't get our full 500 out of it. The market would really have to drop to get the full 500 out of the Russell, and we're only in with a single contract. So the market would have to go all the way down there to give us 500 bucks. Will it do it? Who knows? But we let it go, right? We want to let our winners run and cut our losers short. So we want this thing to come to break even. So we'll just let it go to break even at this point. And once it gets to break even, we got one more minute on the bar. We'll wait for it to go to break even, and then we'll switch it over to the yellow dots. And then we'll just let the yellow dots trail out until the market changes from bearish to bullish once again, and that's where we'll switch our positions. And then we'll set it up and we'll do it again. And we just do this until we get 500 bucks, and then that's, you know, you can set your goal for whatever you want. I just set $500. That's what I like. Again, I'm not telling you how to trade. I'm just telling you how I like to do it. Now we're getting, this is bad news. Look at the Dow. It's starting to pull back after this big long rally that never gave us one single flag. And so that looks like a V recovery on that thing. And if that happens, we'll probably get stopped out here on the Russell because it'll follow the Dow. So we've got 1 second to move that thing to break even. So, okay, now we're at least at break even. So if it comes back, stops us out, we didn't lose anything. But the Dow is starting to rally, which means that the Russell, same thing. So not strong enough to push down and give us a second ABC leg. So what's that, our third trade or second trade? Second, that's our third trade, isn't it? I think that's our third trade. So B. Taylor, did I answer your question? We're actually not in New York. We're in Chicago trading the New York indexes. So out of Chicago, there's an exchange called the Chicago Mercantile Exchange. And they actually have these indexes that they trade over there in Chicago. And there's no pattern day trading rules. So you don't have to have $25,000 to day trade. You can day trade them all you want with a $5,000 account. You can go long, you can go short. There's no penalty. There's no interest. There's no pattern day trading rules. I actually have, if you go over to my website, tradementors.com, I don't have a banner for that. I need to create a banner. Go over to tradementors.com. I have some courses that'll teach you all about the futures market if you want to take them. Well, now we're getting a bottoming formation here. It looks like the market wants to turn and go down. We never got any really good reflections. We got one right there, and I didn't take that one. I tried to take this one. And so this one went up. So I thought we'd go long on this one. We got that clearing bar and then it went down. That would have been probably our best opportunity, and I missed it. It's probably I was looking for the market to actually make a pullback and then another ABC up. And that's why I didn't go short. But I never got my long position in either. So I never reversed it and took me short. So sometimes I'll take a reversal. If you go watch some of our past videos where we've had better luck and better markets, you'll see where we made some good money and where we reversed some positions when you have the opportunity. Now here's a setup right here. There's our green. That's our short position. That would be our next sell right there. See if that holds. This one's doing it too right here. So we got the down, the reflection, the green bars, and down it's going. Here we go. Here's the next one right there. So you got your red down, you got your two green bars. There it's getting ready to go. It's just weak. Here it is again right here. See this one? Down, you got your green bars, and down it should go, should flush again. I just don't trust it. Markets, the volume's falling. Look at the volume. The volume's coming down. Volume's coming down. Volume's coming down. We should have increasing volume on the way down, not decreasing. All right, guys. Well, I've been here an hour, and that's usually my cutoff. I like to stay here for about an hour, from about 7:30 to 8:30. Watch those top of hours, like I mentioned before. Remember the top of hours. We're going to start watching again a little bit more seriously around 9 o'clock and then again at 10 o'clock. And those will be the times that you're going to start seeing trends start to pop in once again, and you can get these reflections. I got a little lesson for you before we go. All right. I always have a little lesson for you. A trader's state of mind. Avoid addiction. Okay. We trade to live. We don't live to trade. Let me fix this so you can see it a little better. Got this fancy thing here. How's that? So this causes over trading. Don't chase the adrenaline rush. Don't chase the win. Destroys relationships. FOMO gives you fear of missing out. And don't miss out on life because you're sitting in front of the computer trying to make money day trading all day long. All right. Set your goals. Try and reach your goals. Once you reach your goal, get up and walk away. Avoid addiction. All right. That's my word of wisdom for today. All right, guys, if you have any questions, you can always send me an email, lhturner@tradementors.com. You can visit me online, a website. I always encourage you to go over and register for Pit News Magazine. We just dropped the September issue. It's wonderful. Has all kinds of audio files in there for you to listen to. And if you'd like a copy, you can get it for $1 for an entire year. Pretty amazing. And comes out every month with multiple articles and audios. Go over to Trade Mentors or go over to Pit News Magazine or pitnews.com. It's just Pit News, not Pit News Magazine. Pitnews.com. Pick up a copy. And if you pick up a copy right now, we're giving away a free this book, Solving the 5 Pitfalls of Covered Calls, How to Trade for Income Using Options in the Stock Market. That's a great little book. Of course, I wrote it, so it's obviously great. And you get that for free when you subscribe to Pit News Magazine for $1. So go to Pit News Magazine, use my code. You have to use my code or else you won't get the $1. It costs you $35, but $35, still a bargain. Let's get the code. What's the code? Subscribe to Pit News Magazine, your trusted source for trading intelligence, pitnews.com, and use coupon code LANLIVE-$1 for 1 full year subscription, 12 months for just $1. And you get Solving the 5 Pitfalls of Covered Calls as a free gift just for signing up. All right, guys. I'm going to do this again tomorrow. Hopefully you'll join me and we'll see if we can't do better tomorrow than we did today. Have a little bit better luck. $12.50. It's better than being red, right? And we got 9 o'clock coming up soon, so 20 more minutes and we'll start watching again. Not here, not live. You're going to have to do that on your own. See ya.